So we're going to continue to talk about various parts of the One Big Beautiful Bill. Boy, I'll tell you, this thing had a lot in it. And it seems to me that we've been talking about it in nearly every episode of Dollars and Cents during the course of the summer since the bill was passed on July the 4th. But it really does have a lot. And so joining me on the program this week, Kristin Castello. Welcome to the program. Kristin is a CPA and a certified financial planner and a certified financial fiduciary on the team here at Nelson Financial Planning. Welcome to the program.
Thanks, Joel. I'm happy to be here.
Well, of course you are, because this is your topic du jour, if you will. This is what you spend a lot of time, well, actually your entire career is focused on figuring out all this tax stuff.
Mm-hmm. Makes it interesting, every couple of years.
Every couple of years they roll out 900 pages of nonsense, and then they leave it to you to try and figure that out. Specifically on the program, so a couple weeks ago we broke down, for our listening audience, we broke down the no tax on tips. We broke down the no tax on overtime. We talked about the Trump accounts, and then we also talked about the car loan deduction. So if you missed that episode, we encourage you to go to our podcast channels or our YouTube channel to find any of those. You can just search for Dollars and Cents, Nelson Financial Planning, or probably the easiest way to do it is go to our website at nelsonfinancialplanning.com. And there you'll see icons. Click on them. They'll immediately connect you. Once you're there, make sure that you subscribe. And then that way, every week when we do the program that you're listening to now, Dollars and Cents, you can get immediately connected on over. My name is Joel Garris. I am also a certified financial planner, but not a CPA at Nelson Financial Planning. Well, we got great folks like Kristin and myself. I'll put myself in that category, where we're here to help you improve your finances. So, on this week's program, we're going to hit some highlights. We're going to talk about what are kind of the little tidbits that we're going to be talking about on the program.
Mm-hmm. So we're going to talk about the senior deduction. So this is the one that gets confused as a Social Security deduction. So we're going to talk about that. Mm-hmm. We're also going to talk about some of the changes to itemized deductions. So that has to do with the state and local taxes. It also has to do with gambling losses and charitable contributions. Then we're also going to hit some on the child tax credit and just talk about what changes are there, and then some business deductions as well.
So all kinds of stuff. And then we got another topic dialed up, and that was sort of the 5 sort of financial boxes to check now if you want to retire early. But as we were prepping for the show, Kristin, I don't know that we're going to get to that topic, so you're going to have to listen to next week's show. We might have time, but there's a lot to cover here in terms of this one big, beautiful bill and all of the different tax changes that are involved in it. You did a fantastic job for the team at Nelson Financial Planning, putting together a nice little summary of all of those key terms, and so I was actually used that for my radio program a couple weeks ago. It was so valuable. So we appreciate that and all the efforts that you do. How did you learn all of that? Did you sit down and read the 870 pages, or did you kind of at least get some expert outside advice on that?
So I leaned on some friends, phoned some friends for that. So just attended some conferences over the summer, also some webcasts, just learning, as much as I can about it. But no, I did not comb through 870 pages by myself.
I guess that is your FICPA conference, right? Is that what you're referring to?
Correct. Yes. So that's the Florida Institute of CPAs. They do a lot of conferences, promotions, all that sort of stuff when new law like this comes out.
And appropriately enough, you are in fact on their investment committee.
Mm-hmm. Yes. So it's a 3-year term that I was appointed for, and I'm on their investment policy committee.
Very good. That would make sense. There's probably not a whole lot of CPAs who also have that certified financial planning credential as well. So very unique, and kudos to you for that appointment.
Thank you.
Very good indeed. And in that way, you can also keep not just the office, but our clients and also our listening audience up to date on what's applying. So, and I guess that's the key question, right? I mean, we're getting a lot at the office. Of all of this, what actually applies to the normal person out there on the street?
Yeah, we've gotten that numerous times. People have heard about the one big beautiful bill, and the one thing they're asking us is, well, what applies to me? So what do I need to look out for?
And ultimately, that really breaks down into some of the things that we're going to talk about today. As we mentioned a couple weeks ago, we talked about the no tax on tips, the no tax on overtime, the car loan deduction, and the Trump accounts. But the changes that we're talking about today really do get into the ones that kind of have universal implication in terms of their usage.
Right. So the senior deduction. So we'll get into the specifics on that. But we've had a lot of people ask us, do I need to be on Social Security for this? Do I need to, file a tax return for this? Do I need to have certain income for this? So it's something that'll apply to a lot of people, but there's just a lot of questions about it.
Going to be answering all of those questions as Dollars and Cents continues, and then toss in some of these changes in itemized deductions as well, which are pushing more and more people to standard deduction, and then that child tax credit.
Right. Yep. So the itemized deductions, you talked about on previous shows that the standard deduction being doubled and being permanent, it's going to cause a lot of people to just continue taking the standard deduction. But what we're going to talk about today is a lot of those itemized deductions are going to be limited even more, which may push even more people to taking the standard deduction.
Certainly a huge shift just in terms of the tax landscape, right? So prior to these changes, which again, these changes are particularly with the itemized deductions, a lot of them are a continuation of what the Tax Cut and Jobs Act of 2018 put into place. And now those changes started this trend where prior to 2018, something like a third of all tax returns were itemizing, right? But now that number is much, much lower.
Yeah, I think it's 10% are itemizing.
Yeah, I think maybe even a little. Like I AI'd it, and they said it was 9.4 before the show. So lower number in terms of the amount of folks that a lot of this applies to. But then you also had a number of business deductions as well, right? I mean, there were some big changes there.
Right. So there's going to be some new deductions that allow businesses to write off 100% of their asset purchases in the first year. So this is something that has kind of been around for a few years since the Tax Cuts and Jobs Act. It implemented 100% bonus depreciation, but then it started gradually decreasing it. So if there had been no changes for 2025, that would have been, you could only write off 40%. So it's a very significant change for businesses, and it's going to cause a lot of tax savings. Well,
and that really is a big one. We talked about that last a couple of weeks ago on the program, where you're already seeing it in corporate America in terms of the earnings. And obviously earnings season for the second quarter effectively sort of wrapped up this past week. Both top and bottom line results handily beating expectations, profits rising on average about 12% from a prior year. Certainly well above the 5% number that was predicted all the way back in early July. So much greater results than what was expected. That is for sure. So that explains kind of why the beat keeps going, so to speak, in the markets.
Yeah, it sounds like corporate America is more optimistic than they were a couple months ago. The earnings calls, the word recession plummeted by 84%. So that's a sign of optimism.
That is true, especially when you think of it, comparing it, they're comparing it to the prior earnings season, which of course would have been in April, and use of the word recession pretty widespread, particularly when you had all those conversations about tariffs. And really since then, since early April, off of those market lows, market's up somewhere around like 30% since then, just from measuring that low point back in early April.
Yeah, but there is still some concentration in the markets. I mean, if we're looking at the sectors, just 2 out of the 11 sectors that make up the S&P 500 are driving 2/3 of the earnings growth.
Yeah, a big part of that, of course, AI,
Right.
and ultimately there's still a huge profit growth happening with those companies that are focused on that, and that is certainly helping to drive the corporate earnings. So next up, we're going to do that deep dive into the provisions of the tax bill and how it impacts you. Coming up next here on Dollars and Cents with Joel Garris and Kristin Castello of Nelson Financial Planning. We are, needless to say, doing a really deep dive now. Like we did a couple weeks ago, we did a deep dive on kind of the no tax on overtime, the no tax on tips, the Trump accounts, and the car loan deduction. This week, we're doing a deep dive on the senior deduction. We're doing changes in the itemized deductions. We're doing the charitable deduction changes, the gambling losses, and the child tax credit and business expenses. I'm exhausted just listing all of that off, but we're going to try and plow through it because people really are starting to ask some questions about what's the impact that this has on me.
Right. So everyone's asking what actually applies to me. And this could save you a lot of time and effort come tax time, because what if you don't actually even have to file a tax return? Or what if you've been itemizing in the past, but all these new limitations make it so you can't anymore? So you don't need to necessarily go through tracking all your medical expenses, charitable donations, that sort of stuff.
There's definitely some opportunities and things to be thinking about a little bit differently. So, Kristin, let's start with that senior deduction. Now, I'm confused because that was supposed to be the no tax on Social Security. Mm-hmm. What happened?
So we didn't get no tax on Social Security.
We didn't get it. Yeah.
So instead we got this extra deduction. So it is a $6,000 deduction per person over age 65. And essentially it just runs for the next 4 years, so 2025 to 2028. So if you're over 65 or 65 and older, and you don't need to be collecting Social Security, but if you are, does it make a difference? So if you're over 65, that's the only limitation on it.
So that's a fascinating little twist. So it is not keyed based upon whether you are collecting Social Security or not. Mm-hmm. It is exclusively keyed on your age, which at 65, if you're planning on going to your full retirement age, which for most people is 67, mm-hmm. then you just picked up an extra deduction, and you're not, in fact, collecting Social Security.
Correct, yeah.
Interesting. Okay, so that's got broader wrinkles and implications than it might have just upon first initial impression.
Mm-hmm. Yep, and then on there is an income limitation. So this is something to keep in mind. So if you are a single filer, if your income is below $75,000, then you will get the full $6,000 deduction. But then there is a phase out between $75,000 to $175,000. So if you're in that range, then you're going to get a little bit less of that $6,000 deduction. And if you're over $175,000, then you won't get any deduction at all.
Now it's per person, right? So if it's
Mm-hmm.
a married couple and both of them are 65 and over, then it actually winds up being $12,000,
Mm-hmm.
right?
Right.
So if I heard that correctly, adjusted gross income less than 150 gets me the whole thing.
Correct, yes. Mm-hmm.
So if I've got 150,000 of income, tax bracket of 22,
Mm-hmm.
so 22% of 12 grand, that's about a $2,600 savings.
Yeah, not bad.
That's real money. That's a real world implication. Mm-hmm. $2,600. That's the difference that this particular deduction winds up getting you. Now there's some caveats, and we've talked a little bit about them, but I want to break down each one of them and kind of think about it as in terms of the questions that you have received so far, Kristin, at the office. First one, do I need to be on Social Security to take the deduction?
No.
Big no on that one.
Mm-hmm.
That's key. Can I get the deduction if I am under 65 and collecting Social Security?
No. So if you're on disability income, that does not count towards you.
Or early Social Security.
Right, none of that. No.
So it's 65. That's it. It's not a function of Social Security. That's a key point that we're trying to emphasize here. Now, what if I itemize my deductions?
Yes. Yep.
Oh, I still get it.
Yes. Yep. It just tacks on to just a regular deduction. Yeah. So it's not tied to your standard or itemized deductions.
So it's like a power booster. It's like a boost,
Correct.
if you will.
Yeah.
Wow. Okay. All right. Well, that's all right. That's kind of cool. How do they determine that income? It's like what's that 150 based on? What is that? Just straight income, or kind of are they, kind of messing with the definition behind the scenes?
So it's your adjusted gross income plus a couple foreign exclusion items. But generally, if you look at line 11 of your tax return, that's the number they're looking at. So if you typically take deductions off of your income, those would not count. It's basically your gross income.
Okay. All right. So not doing a whole lot of funkiness in terms of what makes up that income limit. Very cool. All right. So then, if my only income is Social Security, so do I need to file a tax return? What should be my reaction?
Maybe.
Okay.
So depending on what your
That's
Social Security
is. Any good CPA's answer, right?
It depends.
Maybe. Yes. Yes.
So if your only income is Social Security, then probably not, but it is something to double check. But because this is hitting millions of low and middle income seniors, it's going to probably reduce a lot of filing requirements on a lot of filers that are just collecting Social Security.
Well, and you also were sharing with me a story about, the impact of some folks that were always trying to kind of take money out of their IRA intentionally because they were in a low tax bracket and were able to do that and not have to pay taxes. There's a real planning opportunity for folks in that particular category.
Yeah. So we've got a client, it's a married couple. Every year around November, December, we do a tax projection for them because with their income, it's just Social Security, and we kind of project out how much they can take out from an IRA without triggering any tax implications. So in that case, why not pull money out of the IRA because it's not costing you anything?
And now the amount obviously will go up because of the extra deduction.
Usually it was about $20,000 per year, and now it's going to go up about $12,000 for them because of the extra standard deduction.
So that's a really unique. That's why we do taxes. Actually, do tax returns for our clients at Nelson Financial Planning. There's some real planning opportunities that if you're not kind of having that level of integration of your taxes and your investments, you might be missing the boat on some opportunity.
Right. Yeah, that saves them every year, and they're putting that money into an after-tax account, so lower tax rates, lower capital gains, all of that in the future.
Interesting stuff. Okay, so that's the senior deduction, right? That's the whole soup and nuts on that one, if you will. We'll shift gears. Let's talk about itemized deductions as well. And I guess this gets us into that SALT stuff, right?
Oh, yes. Yeah. So this was a heavily debated item when drafting of the bill. There was, certain sides of the party that were wanting higher levels or higher limits on this, some wanting lower. It was heavily debated.
Yeah, that's the whole discussion of you've got the high tax states that obviously wanted more of this deduction for their constituents versus the lower tax states that didn't really have as big of an impact. Now, again, the ability, if you're writing off your state and local taxes, so that's like real estate taxes, that's sales tax, we're talking about now you're itemizing in terms of being able to do that. So how does the cap work and kind of what, I'm sure that one's got some income parameters in there too. They all have income parameters in there. Yeah.
So the cap increased. It was $10,000. Now it's going up to $40,000. And this is for both single and married couples, which is a little bit unique. So if you're a married couple, without any changes, your cap was at $10,000 for the past few years. Now it's going to go up to $40,000.
So that's a significant jump. Obviously not as big as what many folks were hoping for, but certainly a significant jump in terms of how much that wound up going up. So in terms of strategy, to really maximize out that, what should somebody do?
You should try to bunch your deductions. So if there's a year where you might have property taxes that you can pay 2 years in 1 year,
sure,
that would be a good way to just get the maximum benefit. There are some income limitations on this, so something to keep in mind is that if your income exceeds $500,000 for married or $250,000 for single, there's going to be a threshold, and it's going to reduce the deduction you're allowed to have.
No, that's important. There's always those income thresholds and limitations, but certainly a powerful one. Well, we're going to take a break and, keep on rolling. We've covered the SALT limit. We've covered the other senior deduction, and so we're going to keep the conversation going here on Dollars and Cents after these messages. We are talking through the details of what's in this one big, beautiful bill that passed on July 4th, how it impacts you, and what some planning opportunities are, some key takeaways, all that, kind of the stuff that people really need to know.
Mm-hmm. Yeah, we're just getting to the bottom line, those key takeaways.
Well, and we already talked about before the break the SALT limit, the sales and local tax, and then we talked about that senior deduction, which interestingly, as we were talking about, it doesn't matter whether you're collecting Social Security. It just matters if you're 65 or not.
Mm-hmm. Right. Yeah, that and the income limitation is really the only stipulation on that.
Interesting stuff indeed. So I guess next up to talk through is changes in charitable deductions. This one always kind of seems to keep moving around, and so it moved around a little bit as it relates to the changes now for charitable contributions.
Mm-hmm. Yeah, so there's a new change that applies to everybody. So if you do not itemize your deductions, listen to this because this is something you could take advantage of too. So there is a new charitable deduction for everybody. It's up to $1,000 per person. So if you're married, that's a $2,000 deduction, and it's for cash donations. So if you make donations throughout the year, just save your receipts, save your donation slips. This does not apply for goodwill, if it's non-cash sort of donations, but if you're donating to a charity, you go to a fundraiser, things along those lines, that would count towards that new deduction.
It's got to be money. It can't be stuff.
Right.
Right. Okay. All right. So that's good. Now, this is an extra deduction, much like that senior deduction, right?
Right.
So do I get this regardless of whether I itemize?
Correct. Yeah, it's for everybody.
So again, now, you're seeing where now you got these extra deductions. You got these extra deductions for senior, for being over or age 65 or older. You got this deduction for making these charitable contributions. Was this supposed to make things easier? I thought the point of this was making the tax code easier. Sounds like this is complicated.
It's going to be even more complicated.
And you got to remember all of it. Right? Because if you forget, I did make those charitable comments. Well, that's new, but when does that start?
So that starts 2025. So gotta keep track of those receipts this year for charitable donations.
Because on the charitable, right, it would be that's a new one that starts for everybody then.
Mm-hmm.
Okay.
Yes. Yep. And then there are some changes to the itemized charitable deductions that are going to begin next year in 2026.
Okay.
So those are a little bit more complicated. So with those, there is a new floor that is going to apply to your charitable deductions. So the floor essentially works like the medical deduction floor. So if you've ever itemized before, you've probably seen that with your medical expenses, the first 7.5% doesn't count towards your itemized deductions. So if we're looking at round numbers here, if your income's $100,000 and you have some medical expenses, the first 7.5% of your income, so $7,500 of medical expenses, does not count towards your itemized deductions. So with the charitable contributions, they are implementing something similar. It's going to be 0.5%, so 0.5% floor, and this is beginning 2026. So if you are thinking about making donations and you do itemize, you should probably do that in 2025 to avoid this new floor that they're going to implement.
Otherwise, you lose the value or you lose the ability to write off all of those charitable contributions.
Right.
So that's certainly a particularly important little change that folks need to wear. And again, that's a planning opportunity. To your point, make the charitable contribution in 25 versus maybe 26, because you're going to get all of it, versus in 26 you're not going to get as much of that.
Right. Yeah, that's certainly true.
Bottom line, charitable contributions are changing, and your benefit from them is also changing. If you're charitable minded, there's just a ton of vehicles out there and a ton of things that you can do from a planning perspective to maximize out these. I mean, obviously, you know, we talk to clients a lot about QCDs or DAFs. I mean, those are both pretty important options.
Right. So 2025, kind of keep doing what you've been doing. But 2026, you may just want to reconsider some other vehicles. So if you are over 70 and a half, QCDs are a great option.
And those are, for our listening audience, qualified charitable distributions. And there's a few rules on that. You got to be over 70 and a half. You got to take them from your IRA. They can't come from a Benny IRA. And they have to be made payable directly to the charity. Can't go to you and then to the charity. It's got to go direct to the charity.
Right. Yep.
And then the other option that I mentioned was donor advised funds. So those are funds where maybe you don't have a specific charity in mind, but you want to get the charitable deduction now. You can put money into the donor advised fund, get the charitable deduction now, and then wait and then disperse out money to different charities once you've decided who those charitable organizations are. So definitely some much broader planning strategies to be thinking about as it relates to charitable contributions.
Yeah, and there's 4 months left in the year, so if that is something that is kind of on your radar, or something that you typically do, it could make sense to do some planning around it.
Indeed. Now this next one, Kristin, I came into your office the other day. I saw some lottery tickets on your desk, okay? And I assume that was some early research for this next topic, but I'm not sure it would totally apply because you said you actually won.
Yeah, I won $10.
So there you go. But this one relates to the changes involving how you write off gambling losses, and this one is kind of convoluted.
It's tricky. It's hard to understand, and it's going to be even harder to implement.
Right, because that's a lot of information to try and keep track of.
Yeah, and I think it's going to be more prevalent than usual with these gambling losses because a lot of people have the gambling apps on their phone now, or the online gambling. So I think we're going to see a lot more of this.
Sure, because I think that's more than just playing cards. That's sports betting. That's all of those types of activities that, unfortunately, I'm going to go with unfortunately, are a big part of our society, and the ease with which you can do that is much, much greater than it ever used to be. So what were the old rules, and how have they changed? I think we got to start with the old and figure out what's new.
So gambling income has always had to be reported, so there's no change there. But what it was in the past is that you could write off your gambling losses as an itemized deduction up to your gambling earnings. So if you won $100,000 but you lost $100,000, essentially it's not a perfect offset, but essentially it's a wash. So if we're thinking about it from an economic standpoint, you won $100,000, you lost $100,000, it's kind of a wash. With the new rules, the losses are limited to your earnings, so the same limitation we had before, but you could only write off 90% of your losses. So there's kind of two thresholds now, which you can't write off more than your gambling income, and then you're limited to 90% of your losses.
But if my losses are like greater, so let's use that example of I have $100,000 of winnings, right? If I have $111,000 of losses, then I can still, that still works.
Right. So that's when it would kind of offset. But then at that point, if we're looking at it from an economic standpoint, you are at a loss, but all you can do is get to the zero number there, and then from a tax point, it's a wash. Right,
because otherwise, let's say I only had 90,000 of losses, and I had 100,000 of winnings, then the reality is that I'd only be able to write off 81,000, 90%, 81,000 of those losses, and then I got to pay. So then I have to report and pay taxes on the 19. But the reality is, economically, I only had 10.
Right. Yep.
I get it when you say that's tricky. So, the reality is, if you're reporting this on your tax return, you probably want to use a tax professional. We're going to take a break and continue on. I told you we're going to work through each one of these. We got a couple more still to go. As we go through the nuts and bolts on some of the tax changes that happened on July the 4th and how they impact you here on Dollars and Cents with Joel Garris and Kristin Castello of Nelson Financial Planning. So welcome on back. We're working through some of the details of the One Big Beautiful Bill that passed on July the 4th. A host of tax changes in there that really require you, Kristin, to understand what the details are and how you can use them if you're planning on taking advantage of some of these newer, or should I say, not really new deductions, but twists on the deductions that we've had in the past.
Yeah, so the One Big Beautiful Bill has implemented new limitations. It's also put some income thresholds on certain deductions. So it's really has a lot of clients asking, what actually applies to me?
Well, and if you missed the first 3 segments of the program, make sure that you check us out on your favorite podcast platform or our YouTube channel. So far in the program, we've covered the senior deduction, which is not the no tax on Social Security. Key takeaways there are you got to be 65. It doesn't matter whether you're collecting Social Security, but it's really more age-based. And you also get it whether you're itemizing or not, which is kind of interesting.
Right. Yeah,
so
for
a little
everybody.
Extra stack, if you will, of your deductions. We've got the SALT limit, the sales and local taxes. That one increased to $40,000, so big change over the previous number of $10,000.
Right, and that's a cap for both single and married filing jointly.
Same cap, whether you're single or whether you're 1 or 2 people on the return. That's interesting. Charitable contributions, which we just chat a little bit about in terms of new deductions for being able to take charitable contributions.
So if you don't take the itemized deduction, so if you just take the standard deduction, you can have a new charitable contribution of up to $1,000 per person. It's for cash donations, so just kind of keep those receipts. And then if you do itemize, there is a new floor that is 0.5%, so 0.5%, beginning in 2026.
So this extra standard deduction, the $1,000 and for single, $2,000 for married couple, that applies this year. The floor applies next year. So certainly some key takeaways there is make sure you're thinking about bunching your deductions together, particularly when we think about the SALT cap and this charitable contribution as well.
Yeah, and it could even make sense just to push most of that into 2025 because we're about to talk about a new overall limitation that's going to happen on some itemized deductions.
We still got like 3 more key points after we hit the gambling loss limitation thing. 3 more key points, so let's get through it because we want to make sure that we finish this. Tell us about the limitation on itemized deductions.
Yeah, so there is a new limitation that's going to apply to the highest tax bracket. So if you are in that highest tax bracket of 37%, essentially what is going to happen starting in 2026 is that your itemized deductions are going to be limited to the 35% benefit. So for every $1 of itemized deductions you have, you would only get a 35-cent benefit from it. So if you do itemize your deductions and you're in that 37% bracket, this is happening in 2026. So you do have some time, so I'd say make your donations now. If you need medical procedures, have those now because then you'll get the more of the benefit before that limitation is imposed.
Sure, particularly if you're in those particularly very high income tax brackets. What if I got kids? Don't I get some kind of kids got to be a certain age. I can't do it now for my guys. But the child tax credit, give us the update on what changed on that.
Yep. So the child tax credit was set to drop back down to $1,000 per child. It was previously $2,000 per child. So the One Big Beautiful Bill actually made it permanent that the child tax credit is going to be $2,200 per child, and it's actually going to be indexed for inflation. So it's going to go up a little bit every year, which I know a ton of our clients take advantage of that, and it really does help them on their tax return. So to have it indexed for inflation is just going to be some added benefit for a lot of families.
Well, and a key distinction to your point, Kristin, of this really does help people on their tax return is, along the program here, we've been talking about deductions, right? And deductions are good. Okay, you always want to take all of your deductions, but because they help to reduce down your income. But a tax credit is very different and much more valuable.
It is. Yep. It's a dollar for dollar offset. So it is very valuable.
So having that increase, there is definitely a significant impact in terms of what that tax picture looks like. And now it's permanent. To go it was $1,000, now it's $2,000 or $2,200, and then it's set to go up with inflation starting next year.
Yeah, I think that's going to be another valuable tool. So we do usually see that with the tax brackets, but to see it with credits is pretty unusual. So happy to see that was a part of it.
Big part of it. That is for sure. Now, obviously, there's as with all of these, there's income limits, phase outs, things like that. Where does that start to kind of trickle in for the child tax credit?
So those are going to stay the same. So if you are married, it's $400,000 of income and below, and then if you are single, it is $200,000 of income and below.
So certainly a very, very valuable tax credit. Lastly, sort of the last thing that we wanted to kind of hit in terms of, I knew we weren't going to get to the financial boxes to check if you're planning to retire early. We'll do that one next week. So that'll give you a reason to kind of hang around and listen to next week's program. So if you're thinking about retiring early, that's the topic for you. We're going to cover that on next week because we still got one more to kind of chew through. And this one is big and really relates. We've been talking a lot about kind of the things that affect people individually, right? The questions that we get at the office on a regular basis from our clients and friends of Nelson Financial Planning. But this one has to deal more with sort of corporate America.
Yeah, so the immediate expensing of capital assets that are purchased. So with bonus depreciation, kind of mentioned it earlier in the program, this has been around for a while where we were able to deduct 100% of purchases for the past few years. And then it started going down. So it was 100% bonus for a couple years, and then it drifted down to 80%, 60%, and this year was supposed to be 40%. But with the One Big Beautiful Bill, it has bumped right up to 100%, and that it was actually made permanent.
And that's also retro. I think I saw somewhere there was retro to earlier in the year.
Yeah, so there is a little bit of a weird timing on this. So
of course there is. It's the tax law, so it's got a weird thing to it. Tell us what that weird thing is. Then.
So the date that 100% bonus is implemented for 2025 is January 19th. So what I would say is that if you purchase assets between January 1st and January 19th, just take a close look at when you placed it in service, and hopefully that is after January 19th.
So you probably don't have the answer to this question, but why on earth did they pick a random date of January the 19th?
Couldn't tell you.
Very good. But the good news is it's retro to effectively beginning of the year, but not quite. So if you were spending a bunch of money on capital and large expenses, then, oopsie. Hopefully it's after January 19th. Make sure you check the receipts.
Yes. And then we also have some new research and development expensing. So for the past couple years, anybody that has had research and development costs, which are really activities kind of focused on implementing new products or developing new products, the prior rules said that you had to amortize those over 5 years. Now that has changed. It kind of follows the bonus depreciation where you can write off 100% in the year that you incurred the costs.
The thing on those, Kristin, that we were talking about earlier in the week is apparently there's sort of a special caveat for small businesses. I guess those would be considered revenue 31 million and below in terms of gross receipts. But there's a special provision in this that relates specifically for small businesses.
Right. So if you are a small business and the past few years you were taking these research and development expenses and amortizing over 5 years, you can actually go back, amend your tax returns, and get a refund. So you can go back and say, no, I'm not going to write off 1/5 of my costs. I'm going to write off 100%. And that would generate a refund that you would get from the IRS.
How far can you go back on that?
Just to 2021.
Still, though, that's pretty far. So, and why would I do that? Why would I want to? I mean, would that be a situation where in 21 or 22 I had a huge spike in income? Is that kind of the thing that I would look for?
Yeah, that, or if you're looking to just have more cash or to get money in. But I mean, that's relying on the IRS to be efficient and timely, and that typically does not happen.
Well, and hopefully it doesn't turn into another one of those employee retention credit things where small businesses across America are just getting hit with, oh, you need to let us amend your tax return and we'll get you a bunch of money back. That didn't go so well for the ERC. You might wind up stepping in the same kind of thing with this stuff as well. So some pretty interesting stuff there.
Yeah, and there's still 4 months left in the year, so plenty of time to plan for these changes.
Well, that was a lot, folks, but all of which affects directly your dollars. So we thought it was an important conversation to make sure that we had spent some time during the course of the summer here, and I guess this concludes based on kind of what the tax changes are, at least for that conversation. So next week, we're going to be talking about the things to be thinking about if you're planning on retiring early. With that, we're going to wrap it on up and get on out of here. This has been Joel Garris and Kristin Castello of Nelson Financial Planning.